Hello and welcome everyone to Almus Market Mornings, your daily dose of financial updates. This is your host Swaraj, and with me I have JK, and we will be taking you through the latest updates for the day. Now, there has been progress on the ongoing peace talks, with Russia offering to fundamentally cut back on its military operations in Kyiv. Whether it's tactical or de-escalatory, we'll find that out soon enough. Many other events are being played out. JK, we saw a volatile session after the announcement of this de-escalation yesterday. Apart from that, we have also been seeing the US 2-year exceed the 10-year yields for a brief period of time. JK, what is your sense of these developments?
Hello, good morning. Yes, yesterday's US session kicked off with positive news emerging from Ukraine ceasefire talks. The Russian side said it would fundamentally cut back offensive operations in Kiev and Chernihiv regions to boost trust. And Ukraine offered neutrality in exchange for security guarantees and proposed resolving disputes over Crimea via bilateral negotiations in the coming years. These statements were quite positive, and there was positive reactions from the markets. Although there were other statements from Russian side dousing optimism to some extent, and also US officials playing down the assurances, calling them as tactical move, redeploying forces rather than withdrawing. That is how they characterized it. But I think market was in a mood to believe the developments as positive and rallied. Stocks gained, commodity prices cooled off, including oil, and even the treasury yields came off. So I can only pin it down to the fact that somehow the markets, after having all these turbulences over the last 1 month or more, tends to believe that probably we have seen the worst of this for the time being, and therefore the investors have got into fresh buying of risk assets, and that's where the rally has been seen. In fact, the euro itself rallied from 1.0968 to 1.1136, and that is a testimony to market believing that for the time being the tensions are on the backseat. Economic data, of course, boosted the sentiment. Housing price data from US rose to 1.56 month on month in January, the fastest rate since July last year. US consumer confidence is higher in March from a year low reading a month earlier, that is 107.2 from a low of 105.7 last month. And of course, the yield curve has seen some inversion. The popular 2 to 10-year yield almost inverted yesterday for a brief period, but since then it is positive, but just barely positive. So this is something that is attracting attention of analysts, and whether it indicates recession going forward is something that we need to assess. In fact, Mr. Harker, one of the Fed members, stood out from others, preferring measured rise of 0.25% in rates in the upcoming meetings. Although he said if the need arises, we would raise rates by 0.5%. And importantly, he also saw signs of supply chain issues easing. So overall, a lot of things were supporting the risk sentiment. As far the euro is concerned, Germany's benchmark 10-year bond yield, the main gauge of European borrowing costs, hit its highest since early 2018, and the 2-year yields turned positive for the first time since 2014. Even as the market discounted 60 basis point rise in the rates by ECB this year. So while everybody has been calling for a crash in the euro because of the war in Ukraine and dovish stance taken by the ECB, the sudden expectation of about 60 basis points hike this year and furthermore next year has actually fueled the rally in the euro, which has a huge resistance at 1.1120 to 1150. But I think the momentum could take it higher a bit as more squaring of positions or the month-end related euro GBP demand supports it. Yen also is one which is on the limelight because there has been some stealth intervention by Bank of Japan officials expressing some sort of negative weakness in what they call as negative weakness in the yen, which means that the people viewing yen as a unwanted currency or something like that. So they have reportedly they have sold dollar yen through some major corporations in the US. Sakakibara, one of the former BOJ official, said that there will be direct intervention if the yen breaches 130. Last time direct intervention was made in dollar yen was when it hit when it was in 1998 during the Asian currency crisis. So we not only had a rally in the stocks and then correction in commodities, but also we had uh, correction in the dollar index itself, led by euro rally and Japanese and recovering. Gold, of course, had one more bout of profit taking, falling to as low as 1890 yesterday. But since then, it has recovered since it is fundamentally supported. And there are reports that central banks are once again accumulating gold on dips. For the rupee, of course, we were already seeing the month end and quarter end and year end related flows, which had driven it down to 75.90 yesterday. But then we saw good buying emerge from oil companies as well as PSU banks purportedly acting on behalf of RBI. But in offshore market, as soon as the news of positive talks in the ceasefire emerged, dollar rupee um, crashed to 75.55. Since then, it has bounced to 75.65. Not much of it actually, because we are still about 30 paisa lower from where we closed yesterday. I think USD INR may be subdued for some more time, although major strength will not emerge because of RBI, RBI intervention. They may look to rebuild their reserves, which they had lost, rather sold during rupee's weakness in the last few weeks. So rupee for the day, I expect a range between 75.50 and 75.85. Incidentally, RBI also announced another sell-by swap to be conducted on 26th of April. This is again intended, as I read it, towards adjusting their assets and pushing them into the forward maturities, as well as to address the liquidity, local liquidity. So when they sell in the near leg, they will obviously suck out more money from the system. And this, I see it as a gradual withdrawal of liquidity from the system by RBI. And obviously, we are also looking at inflation in the local economy, as we have already witnessed the eighth successive and daily rise on fuel prices. So we are ending the new year, rather we are ending the financial year with lots of volatility. But perhaps rupee, one should say that the entire year it has moved in a stable manner. We haven't seen either big slide or big rally, all due to central bank's actions of containing volatility and ensuring stability in the macros. So expect the same thing to continue in the coming quarters as well. Thank you.
Okay, that was a very good insight, JK. A lot of turbulence in the global markets, but more risk on sentiment in place. Let us continue to manage our risks, and that's it for today, guys. I'll see you all tomorrow.